Souza. He's a Senior Vice President and Head of Canadian Banking with DBRS Morningstar. Great to have you with us, Carl. We are obviously going to be very closely covering the different storylines that come out of the Canadian banking industry next week. Is there a common thread, though, that you're going to be watching closely among all the players?
Yeah, hi, John. Thanks for having me. To answer your question, essentially, yes, there will be a common theme. And I think that's going to be the theme of provisions for credit losses. So with the continuation of the tough macroeconomic and operating environment from 2023 carrying into 2024, we expect in Q1 that it'll be a challenging quarter for the large Canadian banks, driven by those provisions for credit losses, as well as tepid loan growth. And then on the revenue side, we see net interest income growth will negatively be affected by softer loan growth, with net interest margin expansion likely moderating. On the non-interest income side of revenue, trading activity is expected to normalize, although capital markets revenues may show a bit of a rebound with some signs of deal activity returning to the market. And then on
go ahead. No, please continue.
It was just the last part of it. On the non-interest expense side, we'll be looking for expense discipline from the banks as they focus on positive operating leverage in fiscal 2024, as well as looking at some of the cost controls initiatives that they started toward the end of fiscal 23, continuing into fiscal 24.
I think one of the things that we have in this environment been talking a lot about, and you were alluding to some of this, but the idea of how much money has to get set aside for potentially bad loans. Everybody's trying to figure out where the economy goes from here and what ultimately that means in terms of some of the cautious steps the bank has to take. In theory, if you set aside money for bad loans, you don't necessarily have to stick with that plan if things go better than expected. But that is the kind of move that can weigh on your bottom line performance. So, certainly bank investors will watch that, see what it means for the earnings picture. Given that some of the banks have already set aside money for bad loans, what are you going to be watching for very specifically on that front?
So as you noted, when a bank takes provisions for credit loss, it's a hit to the income statement, and then it gets added to the balance sheet item as allowance coverage for those losses when they occur. And if they don't occur, they can reverse those provisions. So the banks through fiscal 23 materially ramped up their provisions, as we all know, in the expectation of macroeconomic slowdown, increases in unemployment, et cetera, and just a natural deterioration or what we call a credit normalization in the market to occur. And so we do expect this to be the primary driver of earnings with the continued ramp up in provisions for credit losses as that credit normalization continues to progress. The increased stress in commercial real estate, particularly U.S. commercial real estate, will further pressure credit quality in Q1 and amplify those impaired PCLs or provisions. Provisions are broken down into provisions for performing loans, as well as provisions on impaired loans. So that stress or pressure that's been occurring that we all have heard about in particularly U.S. commercial real estate, that will increase those impaired PCLs.
Okay. And is there something that differentiates the different banking players at the end of the day in terms of the overall storyline? I mean, we're looking at, for example, at the share price of Laurentian Bank there, obviously a Quebec-focused bank. Is there anything when it comes to the Canadian economy right now that feeds into how the performance may play out for the different players?
Yes, I mean, I think there's two aspects of this. One, if you refer to the Canadian economy, there's still a lot of macroeconomic uncertainty in the market, and it depends how these things all play out with respect to will we get what is still expected to be somewhat soft landing, how will GDP play out and those kinds of things. When will interest rate cuts start to take effect and alleviate some of that debt servicing pressure that indebted borrowers in Canada are feeling as their mortgages mature? And so as all those things play out, it will become increasingly evident as to the exact impact to the banks. However, one thing that does happen is that, as mortgages particularly renew at higher rates, and people are paying, let's call it 30 to 40% more a month on their mortgage payment, it leaves less money for everything else. So we would expect further upticks in delinquencies on things like credit cards, auto loans, unsecured lines of credit, and those kinds of things. And then the higher rates, the longer they stay higher, it continues to impact the commercial real estate market, and you're getting plummeting valuations there. And there's a big chunk of refinancing that's coming up in the commercial real estate market. And as those loans come up for maturity, they may require additional equity infusions. So there's lots of things packed in there, but I think the one thing that's important to recognize when we're talking about the large Canadian banks is that they benefit from being well diversified by product, geography, and revenue.
All right.
So their commercial real estate represents about 10% of their total loans, and approximately about four of the big six Canadian banks have more notable exposures to that U.S. commercial real estate market in particular. When you look at that, it is manageable because total global office sector exposure remains at approximately 10% of total commercial real estate loans and roughly only 1% of total loans and acceptances.
Carl,